So when you start out investing in index funds and ETFs, your goal is of course to achieve the highest possible return at the lowest possible cost. And here are my top 3 humble tips for achieving just that. Tip number 1, find the cheapest possible fund. This goes without saying, and expense ratio should really be the deciding factor when you pick an ETF or index fund, as it can eat into your profits in the long term. And just a 0.5% expense ratio can actually cut 13% of your return in the long term, and 1% as much as 27%. And if we look at just a very simple example, if you invest $10,000 and let it accumulate over 30 years at about 8%, which is just about the average for the stock market, it could turn into 97,868 at 0.1% expense ratio, but ends up turning into 76,122 with 1%. The cheapest funds are usually broadly exposed index funds that just passively follows a big part of the market. So a global index, the US, Europe, Asia, technology, consumer staples, small cap, big cap, and so on. And since they're passive, they eliminate the need for a portfolio manager who's sitting there buying and selling stocks all the time, so the expense ratio is going to be lower. And just a few quick broad ones you can have a look at would be Vanguard's VOO, VT or VB, Schwab's SCHB or SCHF, or iShares IVV or IEFA. So they've got some US and international ones. They're pretty much as cheap as they come, and they cover pretty much the whole stock market. So you get to join the ride whether it goes up or down. Now, overall, I recommend you stay below 0.2% for your broad indexes, so international or US or Europe, and reserve the more expensive ETFs for the niche ones like technology growth companies or 3D printing companies or mining companies or EV stocks or whatever it might be. These niche ETFs will be more expensive, so you're going to have to pay up, but for your broader ones, try to stay maybe closer to 0.1%. Tip number 2, do not try and time the market. You see, the deciding factor for returns in the stock market is time. As long as you get going and you just consistently contribute to your investment portfolio and don't sell, you will beat 90% of professional fund managers. You know, the stock market goes up and it goes down, but over time it goes up. No one knows when it's going to go down. No one knows when it's going to go up. And all statistics, all studies done on the topic of trying to time the market shows that it is a fool's game, and in the long term it will only lead to losses compared to simply a buy and hold approach. Besides, if you only invest $1,000 and then consecutively invest $200 a month, you will be left with $293,586 after 30 years at an average return of 8%, which is the realistic average for stocks. And if you start early, so say at 25, later than I did, and you stick to the same plan, you will be left with $1 million by the time you retire and pass the age of 70. And for each $1,000 you invest, you will be left with an additional $31,921. So this just goes to show what unnecessary spending and bad priorities can actually cost you in the long run. Now, before I continue the video, I have to jump in and take a comment of the day. So I just pick out a comment each video. It's not scripted. I just read them off now and try to answer them. So this one goes, looks really great. So this is my portfolio, that is. Among them, do you think Tesla and Amazon can continue their momentum in 2021? I'm concerned the momentum will significantly slow down, and if it happens, holding them overweight in your portfolio may impact your performance with both, and I have both of them in my portfolio. That's why I ask you and think about this. Thanks. So yes, if your core holdings goes down, it impacts your portfolio. If it goes up, it also impacts your portfolio. You know, stocks go up and down, and if you don't have any other reason to sell Tesla or Amazon other than they've been doing well and going up, I would just hold them. You know, let your winners win. That's at least my approach. And if you sell Tesla and Amazon, you're going to have a problem, because where are you going to invest it? Are there other companies you believe in more? You know, for me, these are the companies I believe in, so that's where I have my money. It's a simple answer. I know it's not responsible portfolio management, but if I had sold Tesla because of how much it's been going up, I would never have made this much money. It's gone up 1,600% since I invested. And if I follow this approach, I would have sold at 200%, 300%, 500%, 1,000%, and I would have lost a lot of money. This is all in hindsight, but it actually shows that letting your winners win can pay off in the long run. So thanks for the comments. Let's get back to the video. Tips number 3, stay away from low risk funds such as bonds or extreme high yield. I mean, a quick comparison between regular index funds and these safe haven funds shows that they fall short in terms of returns over any period and under any market conditions. They simply underperform. And in the end, the only number that matters is your overall return in the long run. And these come up short almost every single time. They might be consistent, but that doesn't help if they're consistently worse than the alternatives. And you'd think as sort of a patch on your wound, they would take a lower expense ratio, but overall, even these passive bonds and dividend funds actually take a higher expense ratio than the most popular index funds. So the lower return becomes even lower. And whether you're 20 or 70 doesn't matter. Only one number that matters, remember, your overall return. And again, these are safer, but they've been safer and worse. And index funds are already quite safe. And if you don't feel safe enough investing in index funds, I don't know what to tell you, but don't let yourself be sold these funds as, oh, you should have 20% or 30% of your money in bonds. It's just going to lose you money over time. And you can in fact sort them out by going to any website screener and sort by performance, because they will usually all end up at the low ends. And that's even when you account for the dividend. Besides, index funds also pay a dividend. And overall, they just seem subpar. And you know, they might be safe havens where you can stash your money away and keep them safe, but we don't invest to keep our money safe, we invest to make them grow. And they're even growing at a slower pace, so that safe haven have actually made you worse off. So all in all, I don't see any point in touching these ETFs, and if you just turn up the risk a little bit in your stock market portfolio, whether you're 20 or 50-year-old, I think you're going to be better off. So those are my 3 tips. What would I do if I had to put all my money in ETFs? I'd probably put it all in, split between something like Vanguard's VOO, and then I would probably add on a tech ETF like IGV or VGT, and then I would dash a little ARKK on top just for a little risk. So although I said you should find cheap funds, something like ARKK, which is a small, active, really expensive fund, lets me trade expense ratio for additional risk. And sometimes, again, you need to take more risks. And if you do that with ETFs or index funds, that's going to mean a higher expense ratio. So that would probably be how my ETF portfolio looks like. I don't own any personal ETFs for now. Feel free to post your ETFs, guys. It really helps people who are scrolling through the comment section looking for suggestions for their own portfolio. People are just starting out. It's kind of difficult to know which ETFs to go for when there are hundreds and thousands of them out there. Please subscribe to stay tuned for more videos. They come out Monday, Wednesday and Friday at 8 p.m. EDT, 2 p.m. CEST. The other way around. Give the video a thumbs up if you like it. Thanks for watching. Stay tuned for my next one. Take care.